All right, guys, we're back again with another video, and in today's video, I'm going to be going over how to identify the draw in liquidity, and I'll be going over basically how I do my weekly preparation, how I develop a weekly bias, a daily bias, or even a monthly bias too. I'm utilizing all time frame alignments, and I'm combining them all together in sync to put myself in the highest probability conditions so I can tell and predict where price is exactly going to on a weekly and a daily basis. And this will also be incorporating my forever model. So it's basically going to be like a forever model masterclass. So let's just get right into it, and I can show you guys my step-by-step approach. So we're starting off with just a complete time frame alignment overview. And for the people that don't know this already, time frame alignment is consisted of these 6 sections. Monthly key level, which is an internal range liquidity pool from how I use it, which is a fair value gap. And once price reaches a fair value gap on the monthly, you drop down to a daily and frame a market maker model to the monthly external range liquidity pool draw. Same thing with the weekly. Weekly reaches a key level, a fair value gap. You drop to the 4-hour chart. You watch the reaction on the weekly key level to frame a 4-hour market maker model to the weekly external range highs. Same thing with the daily. From the daily internal range liquidity pool tag, drop to the 1-hour, from a 1-hour market maker model to the daily external range draw. 4-hour, go to the 15-minute. 1-hour, go to the M5. 15-minute, go to the M1. And those are how you're supposed to combine timeframes in regards to framing these market maker models from internal to external range draws. Now, in the examples that I'm about to show you and what I'm going to give, you are going to be combining these rather than just using two. So I'm going to go over and start off with the monthly and drop all the way down to the daily and show you how I'm able to combine these to frame high probability biases as well as multiple trade setups en route to our external range draws after we've had a confirmed shift in structure or change in state of delivery from our higher time frame key level tags. So starting off with a monthly key level dropping down to a daily market maker model. Now I have a monthly chart on Bitcoin. And as you guys know this, my step 1 and step 2 are the most important part of my forever model. And step 1 is price reaching an internal range liquidity pool. And step 2 is price creating SMT divergence inside or at the tag of that internal range liquidity pool. As you can see here, we have a monthly bullish fair value gap right here that creates SMT divergence with Ethereum inside of that monthly gap. Make a lower low inside of this monthly bullish fair value gap. So a run of a short-term low. We have a swing high resting here, which is an external range draw. So we're looking at a monthly internal to external range move. So now that we have step 1 and step 2 marked off on the checklist, all we need to do here is drop to the daily and see if we could frame an entry to that monthly external range high. So this is the first thing that you can notice on the daily inside of that monthly gap. So here is I know a lot of you guys will actually probably saying this in the comments. This is the run of that initial tag of that monthly gap. And this down close candle is the one that ran the short-term low inside of this monthly gap. So wouldn't you think that we would run up here, close above this candle, and wait for price to give us an order block at this tag? Yes and no, because we could also frame it down here, like I showed you here. We have SMT running this short-term low on this candle, running this short-term low on this candle as well, with price continuing to close above that down close that also created SMT inside of that monthly internal range liquidity pool. So this could also be utilized as an entry, and you can see price comes up, tags that, and then utilizes it as support, failing to crack this low, utilizing this as a protected low, and giving us our energetic displacement higher while also closing above the candle high that I labeled before and told you guys about. So if this is also the same candle that ran the short-term low, initially tagging our monthly gap, we could also utilize this as an area or a POI for a long position to take price higher. And you could see moving forward, look at how sensitive it is on price delivery here. Price comes up, tags this order block, bounces off, utilizing that as a proper area of support. So this is how I would trade a monthly key level tag to a monthly external range draw and drop to the daily, and you can frame multiple trades off of that monthly internal to external range draw. There was an entry here and there was an entry here. 2 entries from a monthly swing, and that's obviously a bigger position because you're holding this not just for days but also weeks within that given month. So that is how I would approach a monthly to a daily. Now let's get into a weekly to a 4-hour, but not just a weekly to a 4-hour. We're going to be combining weekly key level with a 4-hour, an M15, and an M1 market maker buy model. Now, this could be new to you guys. You might not actually know or understand what I'm talking about here. When price tags this internal range liquidity pool, it creates SMT divergence, and then price delivers us to that weekly external range draw, there's multiple entries within this tag here to the delivery to that external range draw. Because a lot of people will miss the first entry of the forever model and then they'll just let the move run without them. That should not be the case. The case should be understanding that we have our foundation and our base of price creating the SMT divergence inside of the internal range liquidity pool. We now have a confident idea that price will go to that weekly external range high, like we have labeled here. So if we're able to look at the weekly to the 4-hour, why would we not go from a 4-hour to then an M15 if we miss the initial entry off of this gap? Or why would we not also go to an M15 to an M1 en route to this external range high? You can position yourself multiple times if you have a confident idea and stance as to where you know price is going to go to. So I'm going to show you guys this in the next couple of slides. So here is the initial tag on the 4-hour when price creates SMT inside of that weekly gap. We have price closing above this down close candle that ran short-term lows. So all we need to do here next is wait for price to come back over, tag that order block, change the state of delivery candle, put your stop loss at the candle low, take profit at the weekly external range high. And price does that with ease. And I've showed this example before in the past because it is such an A+ setup. But let's say you missed this entry. What am I going to do next? I'm going to watch price as it drives closer and higher to that weekly external range draw. Like anything in here, I'm going to see if I can position myself to get in when I know price is going here. I have my confirmed protected low, but I missed the first low risk buy entry. So I'm going to see if I can capitalize or position myself where we can expect accumulation or reaccumulation in the market maker buy model. So if I look closer in this, there was SMT at 2 separate times in this market maker buy model to the weekly external range highs. We had a fair value gap here on the 4-hour chart that failed to get tagged on NASDAQ, but it tagged it on the Dow Jones. And for other people that don't know this, you don't need a tag on both assets. You just need a tag on one internal range liquidity pool. And we have that on the Dow, and we don't have it on the NASDAQ. So we're going to see if we can position ourselves, since we're on a 4-hour chart, drop to the M15 and frame our entry in the accumulation stage of this 4-hour market maker buy model, since we know price is going to go here. So let's do that now. This is the 15-minute chart after price creates the SMT divergence with the Dow Jones. Now, if I'm trading just New York, I'm not able to capitalize on this, but this is for people that are paying attention. I have marked off the London session, and then here's the opening of New York session for me. So we'll focus on what's happening here on the initial SMT that we created with the Dow Jones. And if there was anything that we were able to capitalize on, since the Dow tagged a 4-hour gap and the NASDAQ did not. Now let's dig a little closer to see if there's any sort of possibility here for me to position myself. Now, if I look closely, I see a short-term low resting here that got ran by this down close candle that created SMT divergence with the NASDAQ and the YM. Price closes above it on this candle. I can execute on the next candle, stop loss at the low, and I can hold the trade for a 1 to 2 risk to reward. I could hold the trade fully to the weekly external range draw. But for me, if I was trading this, I would execute myself and put my position on at the tag of this order block, stop loss at the low, look for a 1 to 2 risk to reward, close 80% at 1 to 2, put my stop loss at break even, and then see what happens if New York can continue. So let's watch what happens in the New York session after we've already positioned ourselves from the 4-hour to M15 model that printed in London. So if we look closely at the NASDAQ on the 15-minute chart, here is price post 8:30. We have a SMT divergence brewing resting here inside of this 15-minute bullish fair value gap. So we just went from the 4-hour chart to the M15, and we were able to frame something in London. Now, since we have even more conviction and we understand that price is drawing to that weekly external range high, and we're combining the weekly to the 4-hour to the M15 to the M1, all to push ourselves in intraday trades because we have a confident weekly bias and draw on liquidity. I can drop to the M15 chart and see if I could frame a model on this tag since we have SMT divergence inside of an internal range liquidity pool. So I'm going to monitor price on the M15 to M1 on NASDAQ on the next slide. So here is price creating SMT inside of that M15 gap. And this big wick here is from 10 o'clock. 10 o'clock candle on the S&P 500 was one that whiplashed and took out all those resting lows while the NASDAQ failed. So with this being such a small body, I'm not going to be able to capitalize on this, and I'm not going to honestly trust it because of how small the body is. So I'm going to kind of wait for more data. I know for a fact now that the NASDAQ is not going to crack this low because this is our SMT. And we have our weekly external range draw. So what I'm going to do is I'm just going to continue. I'm going to wait more data on the M1 to show me if it could still provide structure on the M15 fair value gap tag. So if I look closely, I see a short-term low resting here. And then I see this down close candle was the one that ran that short-term low inside of that 15-minute gap. So I could label this run of the short-term low and this candle right here as our order block and change in state of delivery. As it closes above it, we utilize it as support, holding the mean threshold of that candle and popping, running to our weekly external range high. So you could see here, I just framed 3 different trades from that one weekly internal to external range draw on 3 different aligned time frames. The first one was the weekly to the 4-hour. The second one was on the 4-hour to the M15. And then the third one was on the M15 to M1. So if you're missing the original entry from the forever model, but you know and you're confident in your higher time frame draw and liquidity, why wouldn't you not keep watching price to see if it could deliver you another entry point to that external range high? The external range high has not been taken out yet. So if it hasn't been taken out yet, look for the entry. Look to try and capitalize on a lower aligned time frame on a accumulation stage, a reaccumulation stage, or a distribution stage, or a redistribution stage of that market maker model. You still have area of opportunity to capitalize on the position. Just because you missed the first entry doesn't mean that you need to let the trade go. There's always going to be opportunities. In a market maker model, there's never just one entry to an external range high. Depending on the time frame, especially if we're utilizing our higher time frame like our monthly, our weekly, or our daily, there's never just one entry from a monthly internal range tag to a monthly external range draw. There's never one entry from a weekly internal range tag to a weekly external range draw. There's never one entry from a daily internal range tag to a daily external range draw. So we just went over weekly, combining the 4-hour M15 and the M1. Now let's do a daily, combining the 1 hour and the M5. So I have a chart on GBP, JPY, and I'm looking at the daily. We're going to be doing the same thing that I just did on the NASDAQ from weekly, combining the 4-hour, the M15, and the M1, doing the same thing with the daily, combining the 1 hour and the M5. So let's drop to our align lower time frame and look at the 1 hour chart. So you guys have already seen this trade before. I want to show you A+ setups. These are the ones that look the cleanest. You guys will understand these the most. We have a 1 hour down close candle that runs short-term lows, creating our SMT divergence inside of that daily internal range liquidity pool tag. Also, this is not, I did not mean to put this as weekly. It should be daily. Apologies about that. Anyways, and we're on the 1 hour chart. So we're looking for price to close above that up close candle or this down close candle, and we did. So all we're doing is looking to put a trade on at the tag on the next candle of that down close. Next candle, tags it, and just runs right up. But again, let's say we miss that original entry. What are we going to do? We're going to look for executions after in the accumulation stage or reaccumulation stage. Because you guys know this, there's never just one entry, there's multiple. So look at what we have here. We have 1 hour bullish fair value gaps that create SMT divergence inside of them. High probability. We are creating SMT divergence in bullish PD arrays en route to our daily external range draw. After we have that initial low risk buy, we have our smart money reversal in our higher time frame key level. We know where price is going to go to next. All we need to now do is just frame more trades en route to that external range draw. This is our confident. We know price is going to go there. We're beyond confident in this. All we need to do is just position ourselves en route to that resting high. We just need to wait for the proper time. You need to wait for the kill zone. You need to wait for the PD raise to form. You need to wait for the SMT divergence to form. This is all you need to focus on. So let's look at what's going on inside of these hourly key levels to see if we could frame M5 market maker buy models en route to that daily external range draw. Okay, so we're looking at New York session, opening at 7 a.m., closing at 12. This is our hourly gap tags with our SMT divergence with Euro JPY. So see if you could annotate any entries on these two hourly gap tags. Now, I know for a fact you guys are going to see, you're going to see one of them, but you're not going to see the other. And here it is. The first one, this candle resting here. It runs a short-term low, but it gives no entry unless you bought into the 1 hour bullish fair value gap, creating the SMT. So unless you saw and monitored Euro JPY at the same time when it ran this low and created SMT divergence, and then you bought that SMT run inside of that hourly gap, you would have missed the trade because there was no re-entry on the M5 change in save delivery / order block candle. And that's fine because we could always move on to another stage. This would have been considered accumulation. So maybe we can get an entry on reaccumulation, which is the next hourly bullish fair value gap. And if we look here, what happens at this candle right there? Runs a short-term low and tags that hourly bullish fair value gap. This candle here closes above the down close candle that ran the short-term low. The next following M5 candle tags it, and it runs and holds. And next thing you know, moving into Asia, takes out that daily external range draw on liquidity. Now, you guys can see here also, there was 2 entries or 3 if you bought the SMT run or tag of the initial hourly bullish fair value gap. But let's just say 2 entries to that daily external range draw. The low risk buy, and then the reaccumulation stage of that hourly market maker buy model. Once we identify our foundation of the forever model, knowing where price is going to go to from an internal range liquidity pool tag and then SMT divergence. If you miss the first entry and you're confirmed that we had our change in state of delivery and our lowest buy, if you miss that first entry, you can still capitalize on that trade going to those external range draws because you're so utterly confident in the completion of that market maker buy model. As long as the correlated asset doesn't reach that external range draw before your correlated asset does, that high or low will be reached. And this process and what I just showed you here is exactly how I frame all of my trades. This is exactly how I develop my monthly bias, my weekly bias, and my daily bias. It all stems from the same thing, and that is how I'm so confident in all of the trades that I take, and I show no emotions behind my wins or my losses. It's all business, and it is just another journal entry, regardless of the outcome of the trade. Now, I hope you guys enjoyed this video, you took something from it, and if you have any suggestions for further videos, you want me to show you anything, please drop them in the comments below. I would love to hear your feedback, but take it easy, guys. Good luck, good trading, and I will catch you guys next week in the next upload.